It's important when money goes in at the very early stage, it's important that capital comes out at the other end, right? That it's the excitement of innovation and change in the world and change in the continent is one thing, but capital expects a return, right? If capital does not get a return, it will stop coming in at the very early stages. So it's imperative that we build the infrastructure to enable investors, local investors and global investors, that when they do invest, that we're just not building these companies and continuously build these companies, which is what we want to do, but we're able to give a return.
Welcome to my interview series, where I speak with leading venture capitalists across Europe and global markets. In each conversation, we explore how venture capital is evolving from fund strategies and sector focus to the broader market trends shaping where capital is flowing today. We also dive into how top investors think about backing the next generation of transformative companies. Today, I am delighted to be joined by Gbite, managing partner at ODBA, an early-stage venture capital firm that backs founders building what they describe as improbable stories using technology. ODBA takes a very distinctive approach to investing, placing people at the center of every decision, supporting founders across Africa and global markets. Beyond venture capital investing, Gbite is also deeply involved in building capital market infrastructure, including initiatives like AT50 Index, which aims to bridge private innovation with public market readiness. Gbite, great to have you with us today.
Thank you so much, Vinay. Pleasure is all mine. Pleasure is all mine.
Great, let's get started. To start with, your thesis plus the ecosystem depth, right? ODBA says we don't invest in ventures or products, we invest in people. In practical terms, how do you evaluate people at such an early stage where there is very little data?
Well, thanks for that. That's a brilliant question. It's the one I get asked, more than others. So if you think about it, Vinay, right, at the earliest stage, there isn't enough data to rely on, right? So we focus on how founders think and execute under uncertainty. We look for things like clarity, speed of learning, and whether they can attract belief early, right? Because those are the sort of things that we've got to go by. Because of the stage, you're not backing what exists, you're backing who can build what doesn't yet exist. So it's imperative we look at, some of the skill sets of the founder itself. The business plan comes second when we start early. So when we say improbable stories, improbable stories are, things that people think cannot be built or cannot be done, right? So we're looking for a certain sort of individual that possesses these certain skills to bring an idea or a concept to life.
Excellent. Right? And staying on that, many VCs say they are founder first, but still anchor heavily on metrics. What does a truly people first investment decision look like at ODBA?
Well, so with metrics, early metrics can be misleading, right? They're often lagging indicators. If you really think about it, they're lagging indicators. So what matters more is whether the founder can navigate ambiguity, recover from setbacks, and keep moving forward, right? That's what ultimately determines outcomes. So yes, we do look at a number of these things, but where they're starting off with and where they end could be relatively different. There could be a number of pivots. There could be a number of things that they've assumed that might not be when they start the business. So it's important, like we continue to emphasize, it's on the scale of the founder. So being able to navigate ambiguity and recover from setbacks is more important than a number of these metrics. I mean, of course, that changes later on, but when we're still dealing at that really early stage, this is what we consider to be important.
Great. Now, what makes a story believable enough for you to invest in?
So, I mean, we love a good story. You know, if you think about it, narratives are really, really important. You know, you don't bridge it with storytelling, you bridge it with proof. You know, revenue, retention, real usage is what's important. You know, over time, consistent proof changes perception. So what we are looking for is, you know, a realistic story. Of course, we require audacity to a certain point, but I like to call it a realistic narrative. A realistic narrative, like I said, is proof, right? It's proof is the important thing that we look for. An idea and a concept is just that. It's an idea and a concept, and you know the world is full of them. Being able to prove it, and at the very early stage, it can be difficult, but showing some sort of signs towards that is the narrative story for us.
Interesting. Now let's zoom out on to the markets you operate in. You invest across Africa and beyond. What do investors still misunderstand about building companies in African markets today?
Well, a lot, right? A lot. So an example would be a number of my foreign counterparts. It's very hard for them to imagine how companies can be built with lack of infrastructure, electricity that's not very consistent, road networks that are not amazing, you know, logistics that can change. So it's almost, you know, when you think about it and you think about how we build companies in Britain and the US, it's, you know, there's almost a freeze as to how exactly is this possible. Right. In Africa or in emerging markets, investors tend to view Africa through a risk lens first, right? That's the first way that they look at it. But what they miss is that founders here are building in constraint-heavy environment, right? Now, what this does is it forces discipline and real revenue at the very early stage, right? Whereas in other jurisdictions, you know, you can go after revenue much later on. What it does in places like Africa, it forces that discipline very early, and it ensures that the person building the business does think of revenue early. That often produces stronger businesses than people expect. It also gives a certain stamina for the founders. So when they're building these companies, they're not just, they're getting feedback from the markets in the form of revenue, no matter how small it is. It also gives them, and we say, if you look at the numbers, per dollar that's invested across the globe, Africa does give a very good return. And the reason for that is that the African investor, because he's starved, the African founder, because he's starved of capital and he's not sure whether the next stage capital will come, they're forced to be innovative. They're forced to, you know, really think about things they do before they spend every penny. And that does not compromise the innovation, funny enough, right? Because, you know, we've had the conversation in a number of places where they think that might compromise the innovation, but it hasn't. It has improved a certain muscle and a certain skill that enables them to really push a dollar much further than other folks will be able to push it. So generally, the misunderstanding is the level of risk. Through better storytelling and proof from the founders and us that operate within the space, would enlighten and educate foreign capital to ensure it understands the climate much better.
Great. You've spoken about liquidity, trust, and market signals.
Yes.
Why do you believe capital market infrastructure is just as important as venture capital itself?
That's very right. That's very right. So let's try to paint a picture. It's important when money goes in at the very early stage, it's important that capital comes out at the other end, right? That it's the excitement of innovation and change in the world and change in the continent is one thing, but capital expects a return, right? If capital does not get a return, it will stop coming in at the very early stages. So it's imperative that we build the infrastructure to enable investors, local investors and global investors, that when they do invest, that we're just not building these companies and continuously build these companies, which is what we want to do, but we're able to give a return, real DPI, cash back to investors that invest in. Now, if that's the case, it's different for different jurisdictions. The United States they print the US dollar. They have access to unlimited amounts of capital. So they have the luxury of being able to risk a number of things, right? Here in America, you can fill a company 2-3 times and you would raise capital the 4th time. Now in Africa, access to capital is limited, right? So you might not have another shot. And even if you do have another shot, you have to have a really brilliant network of some sort. So what that means is that if there's no way in which capital comes out at the other end, it's just a matter of time before the amount of capital that comes in reduces, right? Because as I keep emphasizing, the whole point of investing is to get a return. Now, if we're looking at it from that point of view, venture builds companies, right? Venture capital, we go in there, grow really fast, break whatever rules that needs to be broken, grow really fast, and when you get to a certain stage, then improve your governance, improve the quality of the company. But in the beginning, venture goes to building companies. But companies need pathways to scale and liquidity. That's imperative, right? And pathways to scale and liquidity, that's where capital markets come in. It's about how the two connect. That's the important bit. In more developed markets, you have a more developed secondaries market, right? Companies are staying private for much longer. And even if they do stay private for much longer, they do have access to capital. Now, in places where we don't have that access to capital, we can't afford to, superimpose things that have worked in other jurisdictions. We have to come up with things that will work for terrain where our access to capital is not strong enough. Then there comes in our capital markets, because what capital markets does, it gives access to longer term capital. Yes, it might be relatively different from the stages in which we are listing these companies, but it's access to capital that's the important thing, both for longer term capital from these companies who want to continuously build their companies, and also exits for investors that have invested, which is imperative. I mean, an exit is almost as important as that initial investment, because once an exit comes, most of the time, that capital is recycled back from the beginning. But what it does, it gives a general level of belief. It gives confidence in liquidity, in investing in the terrain. So it's imperative that us that operate within the space build a certain level of infrastructure to enable companies' exits, to prepare founders that are building within this space as to how that change in behavior happens when you're going, once you've raised, after Series A, Series B, Series C, there's a change in behavior that is needed from the startup companies, from their governance maturity, their accountability and behavior. Because what that does, it enables you to attract that later stage capital, that secondaries capital. It makes you desirable from the investment banking community, who really look for something a bit more than what we look for in VC. So a strong capital markets is really important for the continuous growth of the technology sector or small to medium enterprise sector in emerging markets. It's imperative, we're beginning to see.
That's a well thought response, Gbite, I must say. That actually ties nicely into the work you are doing beyond investing. Another follow-up question here. You're closely involved in the 80/50 index, which aims to create benchmarks for African tech. What problems does this solve that venture capital alone cannot?
Well, I think it really touches on everything we've just said. So it's not sort of like trying to solve the problem venture capital does not solve. Venture capital has done its own bit, right? It's come in very early and it's backed these companies. Just to clarify, so the indexes are private market indexes. The 80/50, as the name suggests, is 80/50 African Tech 50 Index. The African Tech 50 Index is a benchmark that measures market readiness. It measures IPO preparedness, right? So that's the specific duty or what it's hoping to achieve. Now, another way of saying that is that a number of these companies have raised capital from venture capital, right? From that early stage. So venture capital has injected a lot of money. It does not mean that the companies that do exist on the 80/50, that they will not seek further venture capital. There's a possibility. But a number of them is the next stage, right? It's that next stage of capital, either listing on markets or mergers and acquisitions. And to get that next stage capital, as I just mentioned, there's this change in how you run your business. Venture capital, like I said before, is grow fast. When it comes to investment banking or longer term capital, it's repeatability, it's governance maturity, right? So there's sort of like a growing up for the company to do. And if they're able to do that, you know, that quarterly reports, that's magnifying glass and accountability. If you're able to do that, it gives you access to a lot more capital. So if you think of the 80/50, what the 80/50 is that benchmark between private and public. When private, are really massive private companies, begin to behave like public companies with regards to that accountability, because that accountability is what brings in that institutional capital and that global capital. So the 80/50, the most of the investors that would be invested in the 80/50 is not venture capital. The 80/50 are the mature technology, African technology companies that are now looking for their next stage, which is either listing on market. So you exit the 80/50 when you list on a public market, or you're acquired by another company. So it's the list of companies that investment banking, you know, the investment bankers are looking at to invest. They speak the investment banking language. They show that visibility, that transparency in terms of how they're building their business. And they're of a certain size, right? They're of a certain size. So the thinking behind it is like with every index, somebody in India, in Australia, or in San Francisco or in London, and this is in the investment banking community, can look at companies on the 80/50. They're presented, you know, the way public companies are presented, so they're familiar with it. And the aim is to attract a lot more capital into the companies that are open to show a certain level of transparency. And so far, so good. It's been absolutely phenomenal. The amount of global interest that we're getting from the investment banking community is really interesting. And we're still at the very, very early stages, where it will improve on the scrutiny with cadence. And the more it goes on, the more people are aware, the more exchanges we launch it at, the more the investment banking community will have access to the very best technology companies.
Great. Now, do you think the future of venture capital will increasingly involve building ecosystems and infrastructure, not just investing in companies?
Was that a question, or did I miss that? I mean, that was a lovely statement, which I agree in completely.
Right. I mean, there was sort of a question. I think, yeah. I mean, I'm glad that you agree on it. If you can probably elaborate it a bit.
Okay. So distribution is important, right? Distribution matters. It matters earlier than most founders think. It's the very core of your business, right? So you can have a phenomenal idea. You can even put together a fantastic product. Now, you could spend a whole lot of capital in trying to get that product out there, or trying to buy customers, or you could build communities, right? That sort of like build this product with you, test this product with you. So we think it's a very, very smart way to build companies. You build your community who keep testing your products, your new products as you go along. If, you know, there's a way we look at it at ODBA. We think it goes hand in hand, right? We think building a product, building a community goes hand in hand, because you're going to distribute your product through the community. You're going to test that product through the community. So it's imperative from our point of view. It's I wouldn't say it's easier, but it's better than rather than using capital to acquire customers. So community, and I think the folks that can build communities and can speak to their communities have an easier way to distribute their products, and enables them, of course, get paying customers as early as they possibly can.
Right. Let's shift to your portfolio and what you are seeing on the ground. Looking across your portfolio, are the patterns in the types of founders or business models that consistently stand out?
Well, yes. Yes, yes, completely. I mean, a lot of things have changed, and then it's not just within our portfolio, within our thesis, generally within the ecosystem and venture investing. A few years ago, Vinay, I'm sure you're familiar with this. A few years ago, it was just build, 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 and the customers will come, right? Obviously, interest rates were low. They went as low as 0, I think it was. But now that interest rates are back where they used to be, or in fact a bit higher than normal, capital is being very selective, right? Now, when capital is being selective, if you've not got proof of the idea, possibly revenue or pathway to revenue, capital is going to go where there is a pathway to revenue. So what has considerably changed? What has considerably changed? I mean, it was always the case in Africa because capital was always limited from the onset. But it's just been focused on proof. You know what I mean? That focus, the general change has been that focus on proof, no matter how small it is. And also build communities, as we've said, because building a community is a cheaper way than spending capital. It's almost as if managing your burn is sort of like a new way of fundraising, if that makes any sense, right? Because that gives you a longer period in time to try and prove your concept and get your paying customers. So what we have seen is people concentrating, or a number of our founders concentrating on proof of product and being able to show that the product is needed, right? The strongest founders move fast, but they stay focused. And they think about distribution early, not just product. And as we're saying, they build trust quickly within customers, and execution speed with discipline is a consistent pattern that we're seeing. And this pattern arises more when there's very limited capital.
Right. Let's talk about one of the portfolio companies of yours. Like companies like CUDA and others in your portfolio are tackling fundamental financial infrastructure problems. What makes fintech in emerging markets structurally different from fintech in developed countries or markets?
So we're starting from, or not now, because a lot of work has been done in emerging markets, and I would say we're flying now. Fintech has attracted the most amounts of capital on the African continent and a number of emerging markets. In emerging markets, fintech isn't just an opportunity; it's infrastructure, right? We're starting from ground zero, where we've got a massive amount of people that don't have bank accounts, that are not included within the financial market, so they cannot take part generally in the economy. So fintech in emerging markets, and that's why most of the capital has gone into fintech. We think that will change over time, but it's gone into fintech because fintech is infrastructure. It's the basis in which everybody can take part within within an economy, right? So fintech improves systems. That's another way of looking at it. It generally improves our systems. It's in emerging markets, fintech often creates systems in some cases. That makes the opportunity bigger, but it also increases the execution complexity. If we take some of our portfolio companies, CUDA is one that we're very proud of. They serve over 7.5 million customers. It's a neobank, a valuation of 500 million and growing, servicing Nigeria as well as a couple of other countries. And we see they will continuously grow because they've got a brilliant community. They're laying the infrastructure for everybody to be able to take part in the general and the bigger economy. Because if we think about it, a few years ago, the amount of people that were unbanked, the amount of people that were not taking part in the economy was massive. And companies like CUDA, as well as a number of other financial services companies, have closed that gap. And in closing that gap, you increase the amount of people that can actually take part in the real economy. So we look at things like that, again, founders that understand the problem, founders that think logically, think fast, act fast, not think fast, act fast when they identify a problem, and understand that local, because that's important, right? And that's why fintech has taken on. You've got to understand the local. Some of the mistakes, I won't call them mistakes because that would be unfair. Whoever finances you controls your destiny. And considering a lot of that initial capital was coming from Europe and America, a number of the initial founders behaved like they were building companies in San Francisco or in Shoreditch. Now, with time, what we have seen, like I said, as capital became scarce, what was important is that local knowledge. Now, if you had that local knowledge, you would completely understand that fintech is the first layer. The first layer is to bake that cake, make it as big as possible, make sure that as many people as possible can take part in nation building, right? And then after that, a lot of the capital will begin to go to a number of other sectors. But the reason why fintech has attracted all that capital, because in Africa, it's almost like infrastructure. It makes sure everybody can take part, right? And if you look at the local versus the global, we look for structural problems, not just local ones. And in emerging markets, there are loads of structural problems. So if the underlying issue exists across markets, there's usually a path to scale.
Right. At the seed stage, how do you distinguish between a company that is solving a local problem versus one that can become a global category player?
Well, I think I just mentioned it. So very importantly, structural problems, right? And say, for example, Kuda, for example, was solving a problem of a massive part of the population not even being able to take part in the economy itself. And we see things like that in insurance, just things, education. You first go after real structural problems, not the sexy ones, not the ones that seem cool.
Right.
The ones that would bring in as many folks into a market that they're not playing at. So we look for, I mean, it's Africa. We say almost everything is impactful when we say impact. I suppose some things are more impactful than others. But fundamentally, we look for structural problems, right? Local structural problems. And these problems tend to be the same across the different countries on the continent. Relatively different. Yes, they do have their nuances. But if infrastructure and getting people to participate in the market is the core fundamental thing, that's what we first go after. Later on, we'll go after sexier and more exciting opportunities. But for now, we're looking for the very core, the things that bring together an economy and the things that ensure that it gets more and more people to participate in building the economy.
Right. Many founders often focus on raising capital as a milestone. From your perspective, what should founders actually optimize for in the early stages?
We're building a business. It's not fundraising, right? Product market fit, revenue quality, and customer trust. That's all. Capital will follow that. Once there's clarity, like I said, when we're thinking of the founders, we look for clarity, we look for discipline, and we look for founders who respond when things break. Because when the going is good, it's fantastic. It's when things break, it's when that pressure is on, is where you can identify one founder from another. The real quality comes out when things become difficult. So that's where the real signal is. Now, fundraising is just a result of a really good plan that wants to continuously keep growing, right? Capital will be attracted to, like I said, product market fit, revenue quality, and customer trust. That's what's important. The best founders, not that they optimize. Of course, there's a certain scale, a certain way in which you do raise capital. Fundraising is important. But what's most important are these things: product market, revenue, and customer trust. Because once you do get that, capital will chase you. You can turn down capital. Right. It's not the other way, right? So when you get proof is the easiest way to attract capital. Not amazing decks, not phenomenal ideas. Proof is what attracts capital.
Really? These are incredible insights for the founders, Gbite. Thank you so much. Now, you operate at the intersection of venture capital and capital markets. How do you see the relationship between private markets and public markets evolving over the next decade?
Well, so these are the sort of things, Vinay. It comes back to this fancy thing, but this fancy word I keep saying, which is infrastructure. And that's the entire reasoning between the African Tech 50, there's an African Tech 100, and the AE 2000, which is sort of like an emerging market, small to medium enterprise index. Now, in Dexter, that's building these private benchmarks. They're also doing it across the board. So there's a LATAM 50 that launches later on in the year. There's a GCC 50, just frontier and and emerging markets for private companies. Now, the reality is this. If that gap doesn't close, everything falls apart.
Right.
I mean, I know it sounds whatever, but if the gap doesn't close, it falls apart. And what I mean by that is this. So let's look at States and Europe. Very strong capital markets, and the capital market is how exits occur, right? That is, sort of like a chain. The money goes in early, the VCs do all that investing. Now the VCs need an exit, or else they can't return their fund and can't raise the next fund. So it's an intricate relationship between venture capital and, let's call it, private equity, or the later stage, right? And let's put some things into perspective. These are some of the things we tell a number of the founders that are on the AT50, and a number of founders generally. In the early stage, it's not something they need to worry about because they just want to get into the position of building these great, phenomenal companies. Right. But venture capital, I think it constitutes, I might be slightly wrong, I don't think it's up to 5% of the general capital out there globally, meaning that there's another 90% of capital that's available to build companies. Now, that capital requires a very different behavior from venture capital, right? That capital, longer-term capital, is less risk-averse. It needs a cadence, repeatability, clarity, and accountability, right? So we build all those companies up with venture capital. We start getting up to Series C, Series D, and they're going to need the next kind of capital, which is that investment banking, pension funds, later stage capital. And that capital requires a change in behavior, as we've said, right? A change in more accountability, more governance maturity. So the difference between what makes the system continuously, or the tire continuously move, is that we're able to build these really great companies in the early stage, and you're able to exit through acquisitions or capital markets listing at the later stage. So it's building that relationship and tying them together, because if you think about it, in some ways, behavior for both is very different, right? The later stage are, hence why some are in suits and ties and very serious, take themselves very seriously. And the other sets are very good with t-shirts, jeans, right? Because a very different way and a very different views in how we build companies. But the later stage VC has to get very familiar with that ecosystem, because that's the ecosystem that continues the story. When you list on a capital market, or you're acquired by listing on a capital market, it's not the end, as we say. We say it's the beginning of building another kind of, the next stage of building your company. So things like private market benchmarks and indices is good for the general ecosystem, and it helps bring in those ecosystems. So if you think about it, the AT50 index, for example, is a capital market infrastructure for the investment banking ecosystem to make them more familiar with the best performing companies in venture capital, and to ensure that connection happens, to make sure that these stories go all the way from beginning to listings, or beginning to acquisitions and mergers.
Great. That's a great way of narrating the relationship between private and public markets. Thank you. And finally, if we fast forward 5 to 10 years, what does success look like, not just for ODBA, but for the emerging market startup ecosystem as a whole?
Well, I mean, are you saying the future of venture capital, right? Is this what you're saying? Mm-hmm. Well, the fundamentals don't change. It still comes down to judgment, conviction, and backing the right people early. I suppose what has happened in the early stages, because venture capital, when it came into emerging markets, what a number of people attempted to do was to use venture capital to fund all things, right? Because it wasn't, for a young group of people to get access to capital wasn't normal, right? This is not normal in Africa. So when it did start happening, there was that attitude to try and use venture capital money to, was the answer to everything, where it's not. There are many forms in which we can build businesses, and venture capital is really for those venture capital is the highest form of risk. It's for those really crazy ideas, right? It's for those ones that are absolutely ridiculous. Like I said, you're not investing in what exists at the moment. You're investing in who can build what does not exist, right? So we're looking at some really, so the industry itself will mature. In it maturing, like I said, we will look at things differently. We will not all have the same thesis, which is important. We should all have different theses. It's not one size fits all, right? We all have different ways in which we look at the world. It's meant to be contrarian. So as a result, what that means is it's for the really weird group of individuals. One of the things that is going to be exciting is how artificial intelligence changes the whole game. I mean, that is happening as we speak, both from a research point of view, in terms of how you judge companies, how you look at companies. And now that's going to be really, really interesting. Whether when we take out a certain level of humanity from how we judge it, in some cases, it will make us better. It will make us, it will take away that emotion that can sometimes lead to mistakes. But at the same time, we've got to be very careful, because that human connection is also relatively important in when you're making decisions. I think it will still come into, like I said, that judgment, conviction, and backing the right people. It's interesting to see what artificial intelligence will do, enable us in making decisions. Maybe it makes research much easier. But what it does to the venture capital ecosystem as a whole, it's already happening in real time. I'm sure you've noticed this, but it is really exciting. It's really exciting, especially for emerging markets and the markets that we play.
Great. Gbite, thank you so much for sharing your perspectives with us. It's immensely beneficial for a lot of our viewers, the founders, the investors. There is something to take forward from this conversation. And your speech, especially around investing in people, building market infrastructure, and shaping how capital flows into emerging ecosystems, is truly commendable. It's clear that you are building at ODBA goes beyond venture investing, and speaks to a much broader vision for how innovation scales globally. Thank you again for joining us today. It's been a fascinating conversation, I must say. And to everyone,
anybody, thank you so much. I've enjoyed it immensely, and I look forward to us continuing the conversations. I mean, it's been an absolute pleasure, and I must commend you guys for what it is you're doing. I watched when you did reach out to say you wanted to do the podcast. I did go in and I've watched a few of the podcasts which you do, which is really powerful, from a number of venture capital managers which you do you've interviewed, because it's imperative that we all learn from each other. It's a continuous learning venture. Your thesis will continuously change and mature as the markets mature. So it's been an absolute pleasure speaking to you, and I look forward to speaking to you and seeing you soon, Vinay.
Thank you so much. Really appreciate your time today. And just a quick note to our viewers, to everyone watching, thank you for tuning in. We'll be back soon with more conversations with leading investors across global markets.